Good afternoon. Welcome, friends and colleagues. Welcome to those streaming online. To the Korea Society, I'm Stephen Norper, Senior Vice President of Policy here, and we're delighted to have you with us for our kickoff to the policy and corporate season. We have a rich calendar of events in policy, corporate, and the arts that will be available here for you as you exit today. And if I could just highlight three of those upcoming that we know will be of special interest to those of you here in the audience. On October 22nd, we host Ambassador Kathleen Stevens for a discussion of new strides in U.S.-Korea relations and what at that point will be an analysis of the visit by Park Geun-hye to the United States. We also have on November 12th, examining the South Korea-China Trade Pact with Jeff Schott from the Peterson Institute of International Economics in Washington. And we also have a program with Robert Carlin, senior analyst formerly of the U.S. Department of State, now with Stanford University, on reading the two Koreas on political and security concerns on December 1st. Those are but three of a very rich menu of offerings we have ahead. But today it's really a delight to have our new president, Tom Byrne, in conversation with a good friend of the Korea Society, Charles Kimball, the managing director of the Korea Center for International Finance. They will be discussing China's market meltdown and growth slowdown, what it means for Korea. Charles was previously the chief investment research consultant for Apsara Asset Management in Shenzhen. And before that, he worked for JP Morgan Investment Management in equity research, in economic fixed income and public policy research, as head of research for Morgan Trust Bank in Tokyo, and as head of international investments for the JP Morgan Multi-Market Special Investment Funds. He is a graduate of both Harvard and Stanford University. And Thomas Byrne joined the Society this August as president. He came to the Society from Moody's Investor Services, where he was regional manager, spokesperson, and director of analysis for the Sovereign Risk Group in the Asia-Pacific and Middle Eastern regions. Before moving to Moody's in 1996, he was a senior economist of the Asia Department at the Institute of International Finance in Washington, D.C. And Tom has a degree from both Johns Hopkins SAIS, as well as experience in Korea as a volunteer with the United States Peace Corps. So we're delighted to welcome to the stage for this very important discussion on China's market meltdown and growth slowdown, what it means for Korea, Charles Kimball and Thomas Byrne. Please.
Welcome, everybody, and welcome to two friends I noticed, and ex-colleagues from Moody's. I'll start off with some comments about China's market meltdown and growth slowdown. I'll try to add some color to it. Hopefully that will go some way to improving our understanding of what's happening in China. And then we'll try to tie this in to Korea. And Charlie Kimball will take it from there. We'll try to limit our comments to about 20 minutes, maybe a little more than that, so that we have ample time for Q&A, and so that everybody can get out of here and back to work within an hour. Okay, so it's the first time I've used this. Okay, right. So what this slide shows is the rise and rather dramatic rise and fall in China's equity markets, namely the Shanghai Stock Exchange, this year. So, in commenting upon this, I'll try to weave in some elements, some factors here. One, what comes to mind is a quote from Mao Zedong, even though China's stock exchanges were set up way after the Cultural Revolution ended and Mao Zedong died. And Mao Zedong, one of his sayings is that a revolution is not a dinner party. While not violent like a revolution, the volatility in China's markets in recent months may have President Xi Jinping and Premier Li Keqiang thinking a similar thought, that neither is reform a dinner party, nor like writing an essay to elaborate on Mao's quote, nor embroidery. So what we see here is that from the peak, China's market which is the dark line, has contracted 40%, stabilized in recent days. I threw in Korea Stock Exchange Index there too, even though it's on a completely different scale, and so the degree of contraction in the stock exchange, at least initially, is much less. And Charlie will elaborate, certainly with more technical expertise than me, on what this means for Korea's equities market. So what's happening is that this has caused, of course, much. It's been well noticed. It's caused much concern in global markets. So China, as a global economy, has become more dependent on China's economy as a source of growth since the global financial crisis. Global financial markets have become more sensitive to the performance of China's equity markets. I think the global equity markets are looking at China's own equity market as an indicator of the strength or weakness of the economy. However, what we noticed, particularly in the rise of China's, in the run-up that lasted until this summer, this year, is that the wealth effects were muted. Certainly, they weren't obvious. The run-up in the equity market this year in China was not associated with any significant increase in personal consumption, employment, or corporate investment. And the reasons for that are household financial wealth. Only about 8%, as at the end of 2013, was invested in the equity market. Another is that corporations are funding in the corporate sector can be looked at through this measurement called total social financing, and only 3% of that was in the equity markets. So the direct effects on funding and financing and wealth of households and corporations was pretty restricted. But also, in explaining the run-up in the equity market, I think there's other things that are important to look at. One is that there's a lot of savings in China, about 50% of GDP, gross national savings. I'm aware of only one other system now globally, now that oil wealth has dissipated in the Middle East. I'm aware of only one other system globally, and that's Singapore, with as high a national savings rate as China. And so China has a lot of money looking for yield. And as such, that money started to flow into the stock exchange for a number of reasons. One, there was tighter regulation on the shadow banking system as the Chinese authorities tried to rein in leverage in the system. And then another was that there was a government policy. Government officials encourage investment in the stock market for economic and social reasons. One was to expand the use of equity funding for corporations to allow them to deleverage, and another was to boost household wealth and income through share ownership. That didn't work out, as we see, and so the unintended consequences were I think pretty surprising to the authorities in China, and the unintended consequences of such social policies actually remind me of what happened in the U.S. with the array of policies that promoted home ownership and leverage, and this contributed to the financial crisis that we had back in 2008 and then the recession in 2007. But on the downside, there could be asymmetrical effects in China. I think one of them could be indirect in the sense that there's probably an erosion in confidence even within China of the policymakers' capabilities. Concerted efforts to stabilize the market when it started to correct failed to arrest the price correction in that early stage of decline. And there was a wide array of measures that the Chinese authorities took. These measures included interest rate cuts, cuts in greater flexibility in the reserve requirement ratio, money that banks have to hold against future losses, although it still remains very high at 18% for the major banks. The launching of a stabilization fund, relaxation of the PBOC itself providing margin financing support. Central Huijin, that's a subsidiary of the Sovereign Wealth Fund. It's a shareholder in Chinese banks and investors and financial institutions such as brokerages. And the central agent purchasing ETFs to support the market. There were other measures as well. These all failed to arrest the decline. But that could be perhaps one of the greatest effects on economic effects, is erosion in confidence, and therefore a risk-off, unwillingness to invest, and greater savings on the part of households, unwillingness to invest on the part of corporations. So that's the market meltdown. I think another significant development is China's August devaluation. And here, the authorities devalued the renminbi by 4.7%, I think it was August 11th. Now, this wasn't the first downward movement in the renminbi. Previously, the authorities had signaled that the one-way bet on the appreciation of the renminbi was over. Now, what has gone on in China in recent quarters has been large capital outflows that have exceeded the surplus on the current account and the balance of payments. Although the exchange rate has stabilized in recent weeks, this has come at a great cost in terms of the usage of foreign exchange reserves, particularly in August in China. Nonetheless, I think on this slide we also see that another point I wanted to make is, nonetheless, there probably still is pressure on the renminbi. However, the authorities have a huge amount of foreign exchange reserves. We don't see this as having any adverse feedback loop into the meaning that China would be more greatly exposed to outside pressures coming from financial markets and currency markets, as the buffers still remain quite adequate. Nonetheless, as at least a casual correlation in the equity market between Korea and China, as well as other global financial centers, there seems to be some correlation as well between the Korean won movements and the Chinese yuan movements. Again, they're on different scales, so the weakness probably isn't as great. But what happens in China doesn't stay in China anymore. It has effects on regional markets as well as global markets. Turning to the growth slowdown. This gives you the long historical perspective on China's growth performance from the heady days before the global financial crisis to the acute correction in growth that occurred with the collapse in global trade following the Lehman panic in late 2008, and then of course the big run-up in growth was due to the policy response, the use of the banking system to pump large amounts of credit into the system. But the growth slowdown since then, I think, is an inevitable consequence of a number of factors. One is the policy itself. The third plenum of the 18th Party Congress in late 2013 signaled that it will embark upon an economic rebalancing, economic reform policy, and these policies will unfold over a fairly long time frame, probably through the end of this decade. But at the same time, I think the growth slowdown is also due to the unintended consequences of the credit boom that was unleashed as a response to the global financial crisis. We see that there's a large debt overhang in corporate sector debt in China, as well as a large industrial overcapacity overhang in key industries such as steel, aluminum, cement. And this process of unwinding these imbalances has not ended. And as we see in recent months, it won't be a smooth and predictable process as well. Now, there's a lot of questioning on China. Let me just turn back to, not adept at this. Yeah. Okay. So here we see a gradual reduction in China's growth rate. A lot of observers question these figures, and there's a sense that what you see is not what you get in terms of the actual underlying strength in the Chinese economy. So, looking at some other indicators, there seems to be a greater weakness in the Chinese economy, perhaps suggesting that this process of rebalancing and reform and deleveraging will put further downward pressure on China's growth rate. And then Charlie will talk about what implications this has for Korea. So one of these is the manufacturing PMI index. 50 is a threshold between expansion and contraction by a majority of purchasers. And since late 2014, late last year, the PMI, manufacturing PMI, has dipped below 50, except for the Chinese New Year blip. In fact, it's down fairly significantly. Again, this suggests that there are pretty significant downward pressures on the manufacturing sector in China and therefore on growth. And then my last slide related to China to put some framework on our discussion here is the global iron ore spot prices. Now, these have fallen about 70% since the peak in 2011. And I think this indicator is significant because, one, China is the world's largest buyer of iron ore. And so therefore, if iron ore prices are continuing to weaken, it means that the process of wringing out the overcapacity in the steel industry, the pressures on the construction industry have not ended. Now, China's not the only purchaser of iron ore, of course. There are other companies and other countries that purchase iron ore. I think it's also emblematic or reflective of ongoing sluggishness in the global economy, as the global economy has failed to completely heal from the effects of the 2008 crisis. And just to note that in the first half year of 2015, iron ore volumes actually contracted in China. Also, an anecdote, the authorities allowed a centrally owned steel mill, it was a subsidiary of a larger steel mill, to close in a town north of Chengdu, which is a rare event. So this process of rebalancing, restructuring, and therefore economic downturn in economic growth, I think, is still unfolding and has more room to run. So what does this mean for Korea? One is that we see here in recent months the year-on-year performance in China's growth has slowed, and it has also slowed in Korea. So one of the questions I'll ask Charlie is that to what extent is this slowdown in Korea's GDP growth due to the slowdown in China, and to what extent is it due to other factors? And the channel for the slowdown of growth, I think, to a large degree, is due to comes from the trade channel. Now here, the red line is actually its dollar values in China imports, but you can see the recent months are down from the value of imports a year ago, and China's imports are actually down 14% year on year in August. Korea's exports, the scales mask the weakness in Korea's exports. Korea's exports this year have remained very sluggish, actually contracting, and in August alone, exports plunged 14.7% from a year earlier. So with that, I'll turn to Charlie, and Charlie, I think you have some slides as well.
Hopefully.
Let's see if we get these.
Good.
We do. Here we go.
Okay. And how do I advance this? Just push on the advance?
Yeah.
Okay. Okay, first I should tell you, Tom, I am very pleased, honored to be asked to be here for the first discussion under your new presidency. So I thank you very much for inviting me.
It's an honor to have you
do
here.
this.
A mutual honor society. It's a
Okay.
society.
Now, there are a few different things that I'll talk about. One is the current Chinese stock market collapse. Things I'll say may be more different from what Tom says because I won't have the same things that I agree with. It's not that I disagree with him in general. And similar about the Chinese growth thing, I will shrink my comments down there and then focus on the impact on the Korean economy and then policy implications as I see them. for me, as I lived in Shenzhen, China from '06 to '09, the current stock market collapse is very reminiscent of what happened, a bubble in '06 and '07, a collapse that began in October of '79 and continued for over a year. What's different in the current collapse is the magnitude. The magnitude of the decline the previous time was 70% from peak to trough. This one so far is nowhere near that. It's a little more than half. The duration, the current one is a few months. That one was over a year. The economic impact may be different. What I would say is that the economic impact you might expect from the earlier one being much deeper and much longer would have been greater, but in fact it was almost nothing. As Tom's slide on the Chinese economy showed, the major dip in growth in China was related to the global financial crisis. It was similar in timing, but when policy stimulus came in, growth got right back up toward where it had been before, high single digits, low double digits, and even at the worst, it was still around 7%. So the collapse, even though deeper and longer, did not have an impact. And I say that because one might then say, okay, this collapse will not have much of an impact either. And there are a few reasons to think it might be more. What I noticed when I was living there was that people who had done well in the stock market would talk about it to their friends and family, and they'd have like banquets, it was reported, and people would say, old Joe, how did you do this? And he'd say, oh, and he'd name a bunch of stocks. And not only was that presumably happening in the current environment, the current boom, but the government did something very different as opposed to 2006-07, when the government was afraid of a bubble and it did things like put in a capital gains tax. Market dropped 20%, it pulled off the capital gains tax. This time, the government was actively encouraging a wealth bubble by, among other things, encouraging margin leverage. And that is presumably the exact opposite of what you want to do during a bubble. And since most people who got into the market in terms of the numbers of new accounts that were opened were primarily this year in China, there could have been more of a wealth effect on the upside. No data to support that, as you said. For example, automobile sales were just strong, but they've been strong for years. However, in the opposite direction, what we saw was that for the first time on a year-over-year basis, automobile sales in July dropped surprisingly. And they were reportedly going to also slow in August. One doesn't know if that's a consumer wealth effect related to the stock market, if it's a psychological effect related to the stock market. We can just see that in that example, there was an impact. But so those are sort of my takes on how this one is different from the other one. There may be some economic impact, but it should be kept in mind that only 8% of Chinese reportedly own stocks. And so even with leverage, and even with that being 100 million people, that may not be a major effect on the Chinese economy. That leads into the second topic, which is China's growth slowdown, which Tom has well covered. I have concerns about the data too. In my years in China, one of the adages that kept with me was don't trust the numbers. And this was true on a macro scale and on a micro scale. In terms of the macro things, the one that sticks with me, but similar to one that Tom commented on, is energy intensity. The use of things like electricity has gone down, and it's actually negative in some of the recent months. More recently, it's been sort of flat, and that's so much less than reported real GDP that one has to think how much improvement in energy conservation, how much reduction in energy intensity has been going on. Is it believable that it could account for a 7% difference in GDP, or is there something going on which is widespread suspicion of the macro data numbers that are reported? But even if we look at the macro data that are reported, there are disturbing trends. And the one in particular that we've talked about before is the credit growth in China. In the last 5 years, it has been exceptional, such that debt to GDP has risen from what might have been considered to be a worrisome level a couple of years ago to, I believe, it's the highest in the world at this point in time. And that's not only disturbing because of the high level of debt to GDP, but it's disturbing in terms of the slowdown in growth that has occurred despite the rapid growth in credit, meaning that there is a significant diminishing marginal return to an extra dollar, yuan of credit. And that's worrisome. And then the last comment that I would make about China's growth slowdown is with respect to the rebalancing that they're doing, as you said, away from the savings and investment export-led model to a more consumption-driven one. And what I would say is that this is a necessary rebalancing. It's not just something that's desirable, but it's necessary. As your PMI chart showed, there's been significant weakness on the manufacturing side, and so they do need to go over toward the consumer side. It's not just something that would be a better, more balanced growth. It's something that they need to succeed in. There are a few concerns that I have with respect to the Chinese economy, that the slowdown could be more than is generally expected, and this is significant for the Korean economy, as I will get to soon, in terms of how much slower it could be. Recently, J.P. Morgan published an estimate that for every 1% negative shock in Chinese growth, the global economy will be about 0.5% less. Most of that will occur in emerging markets, where there's almost a one-for-one spillover, J.P. Morgan estimates, as opposed to developed markets, where it would be about a 0.2 spillover. So there would be an effect if there's a significant decline in China. And then last, I would call attention to the recent report that was highlighted on Bloomberg by Citigroup's economist, Willem, I may mispronounce it, Butter. And he cut his growth forecast for China to 2.5% beginning in mid next year for the next few years. And he thinks that will lead to a moderate recession globally. That is consistent with his view that Chinese growth may be really only 4% rather than 7%. So it's only slowing from 4 to 2.5, and consistent with J.P. Morgan's trade-off in terms of emerging markets and the global economy. That would slow things down, but not from 7 to 2.5, but from 4 to 2.5. So it wouldn't have a huge impact. Now, as Tom said, the reason this is important to Korea and the Korean economy is because Korean exports to China are significant. I should give his background. I joined KCIF near the end of 2010, and when I began writing, and I should even go back further, KCIF was founded, the Korea Center for International Finance was founded in 2000, and the charter is, as a result of the Asian development crisis, we founded this KCIF group with the view that this shall never happen again to Korea. So we are meant to be an early warning system. So when I do my weekly reports, it's more oriented toward risk than toward opportunity, although there are some times when I feel that there are opportunities that I should write about. Since I began writing these reports, one recurrent theme, and it draws on my investment background, is that the percentage of exports to China, which, as Tom said, is around 25%, is high, and it should be diversified away from. Portfolio managers generally believe in diversification to reduce risk. And so I pushed that for a number of years, but of course it was hard to do with China growing so much more than the rest of the world. And so as a result, if anything, it has trivially increased in recent years in terms of exports to China. And equally worrisome is when you include exports to the rest of the region, that is ASEAN, in Hong Kong, Taiwan, Singapore, you get up about to 55% of exports from Korea go to these places, which will not only be impacted if China slows down, because as Morgan said, emerging markets will be hit more, but these places will be hit because they also serve China a lot. So Korea is exposed not only directly in its exports to China, but indirectly in its heavy dependence upon exports to other countries in the region. Now, as my concerns about China increased as the debt to GDP exploded, I changed my wording to Korea to say things like, Korean manufacturers should carefully scrutinize their expansion plans, which was about as strong a form as I felt I could say, rather than don't do it, don't expand because it's your business. You should be able to know more about it than I know, but be very careful about expanding capacity, particularly export-related capacity to China. This worry has only gotten heightened by a recent meeting that I attended. It was a U.S. automotive conference that J.P. Morgan had on U.S. autos, a couple dozen companies. And I should step back and say that shortly after I made my comment about being careful about capacity expansion, Hyundai indicated that they were making a major investment in China. And my initial reaction was, well, that's probably okay because it's automobiles and it's in consumer. And so that could be something which, even though there may be a moderate slowdown, in the intermediate long term, automobile sales in China will be a growth market. And it's relatively small, 20 to 25 million sales per year compared to US, which is 17 million if you consider that their population is 4 times ours, and most of the people don't own cars. There's a tremendous amount of latent demand. So there's a good chance that if there's a slowdown, I thought when I saw Hyundai's expansion, that automobiles will be a good area to be in. But at this automotive conference, a couple things came up. One was that there's significant underutilization of capacity in China already in automobiles. It's 64%. Now, does that mean that if they have 25 million sales, which they had through the first half of the year, that means there's 40 million in capacity? I mean, that's a lot of capacity. That's a lot of growth that they're planning for. And here comes Hyundai and others adding more to it. So I got somewhat worried about that. And the second thing that came out at this meeting was the drop in demand and sales in China on a year-over-year basis that reportedly was continuing in August. We'll get the data, I believe, next week to see to what extent it did continue. And so it's not only, places like steel, where we've seen extreme excess capacity in China. And yes, there is, a plant that has shut down. But even when I was there in 06 to 09, the government was trying to encourage steel capacity to be shrunk. And this is one of the first examples I've heard where one is actually closed. Typically, the manufacturers hope that their competitors will close. They don't want to close. And then the other place where there seems to be a lot of excess capacity is in the private residential real estate, which we've seen reports of these cities which have large apartment buildings that are essentially empty or near empty. And I saw that in Shenzhen when I was there, and that was many years ago before the real estate boom really exploded in China. So I have raised my feeling about the risk of a significant slowdown in China from, I used to say it was trivial, by which I would mean under 5%, to now it's non-trivial, by which I would mean, say, 25 to 30%. But as I thought about that, I realized that compared to trivial and Butter's estimate of a 55% chance, 25 to 30 is sort of in the middle, and I definitely lean toward his. I wouldn't make it the majority consideration, but the risk is higher to me than just 25, 30% of something going wrong in China. And so then the question is, what does this mean in terms of policy implications for Korea? Because it will hit exports significantly, but not only will it hit exports, it will hit exports to China, but it will hit exports to other places because, as one of the Ford purchasing managers at this autos conference I was at said, he said, we at Ford are not worried about a temporary automotive recession in China. We will just export from China to the rest of the world. And my immediate reaction was, I'm sure China's not alone. Other companies will do the same. And that means that there will be a glut in automobiles globally if China has an automobile recession. And that's not good for Chinese manufacturers. So that's a concern that I build into this will have an impact on the Korean economy. I know you plan to talk about fiscal policy implications later or recommendations. I'll stay more on the monetary policy side. This relates to forecasts that JPM has had for the last 5 years on the Korean economy. And in line with what Tom said, there has been relatively slow growth. I should explain this chart. The numbers are when the date of the forecast occurred, when it was made, and these are the forecast numbers, and these are the results for the next year. So these numbers are for 2011. For the next year, their forecast for 2012, and this is what happened. And what you see is that the consensus economists and the Bank of Korea have high numbers for next year's real GDP, not only that they would improve from the current year, but relative to what actually happened. But even more important for monetary policy, they have inflation going back to normal or to what they would like it to be. And the actual inflation is significantly less than forecast. And what that means for monetary policy is that real interest rates ex post turned out to be significantly higher than they at the Bank of Korea were forecasting. And I've spoken with the BOK about this. What can I say? I'm not sure if it's deaf ears or, but they continue to, in my opinion, while they are reducing rates at a significant pace, they are lagging in terms of what they actually should have done if they wanted real interest rates to be lower than they actually achieved, because inflation was so much less than they expected. And the important thing about that is that on the margin, other things being equal, is negative for growth. It's relatively slight compared to what could be coming from China, but the monetary policy recommendation from this is to me clear that they should be more proactive. Now, I will once refer to the discussion that Phil Settle and I had back here in April, and Phil spoke about the long-term growth patterns in China, Korea, and Japan, and his observation was, and I believe it was true then and still true now, is that Korea is following Japan with a significant lag in terms of slower growth and lower inflation, and that will mean that the Bank of Korea will have to approach, he said, go to zero interest rate policy. I would say approach. And his view was that they may be going there kicking and screaming. And that seems to be correct, where yet again today they did not lower interest rates. That was what was expected, that they would not lower interest rates. So it's no surprise to the market. But to me, on the margin, it's a disappointment, because I believe that the risk is that the economy next year will be weaker than they expect, and then inflation will be weaker than they expect. I don't have anything more to add in terms of monetary policy. On fiscal policy, my short view is I'm sorry, I didn't put it here. It's the previous chart, but it's basically they should keep their powder dry. They should have only small incremental fiscal stimulus in the current environment, keeping their debt to GDP very low compared to other emerging markets, and very, very low compared to developed countries. And they should keep their budget pretty much in balance. And the reason for doing this, in my opinion, is because if something should happen to go wrong in China, it would be very good to have lots of resources that they can draw upon. And by keeping their ratios in good order, Tom's follower at Moody's and competitors at S&P and Fitch will keep ratings on Korea very high. So should Korea need to have a major stimulus program, they will have ample resources to do that.
At low cost.
Yeah.
At low cost.
At low cost.
Right.
That's a good point. Yeah.
I think that's it then. Well, thank you all for coming here and participating in this discussion.
And please, a
Between
round of
myself and
applause
Charlie.
for Charles Kimball and Tom Byrne. We hope to see you back for more of these dialogues. I would like to thank a few people, in particular to Nikita Desai, who organized this event, as well as Seho and Jane Kim, who are essential staff members here and support all of our programs. Also to point out that we do have Nick Bratt from our board, and also our chairman of the board, Ambassador Thomas Hubbard, and Mrs. Joan Hubbard. We're very grateful to always see them here in the room. Thank you all for your time on this Friday, and we do want to see you back a lot over the course of this fall and winter. There are some copies of the calendar out front. If you're not a member, we do have folks here today who can sign you up, or you can go to koreasociety.org. We'd like to thank all of our online viewers, as well as those who download this via audio podcast or video view, and this is available to you as a participant via video and audio podcast as well. So thank you again, and we look forward to seeing you back in the near future. Have a wonderful Friday.